Welcome to Market Call. I'm Paul Bagnall. David Burrows is our guest on the show today. He, of course, is President and Chief Investment Strategist at Barometer Capital Management. He'll take your questions on North American large cap stocks. So pick up your phone and give us a call. The number is 1-855-326-6266. You can also email us at this email address, marketcall@bnnbloomberg.ca. So get busy with your questions. David is just minutes away from taking them. In the meantime, let's welcome David to the show. It's great to have you here. Thanks a lot for coming by.
Great to be here.
Let's talk about your view of the market. You think the macro setup is constructive for risk assets, i.e. stocks right now?
Yeah, we do. You know, since April, the internals of the market, the breadth or the percentage of stocks performing well has been slowly improving. More importantly, markets around the world are doing this. It's not just the U.S. stock market. Of course, U.S. stock market's about the weakest of the major markets,
right,
as the U.S. dollar has been weakening. But it's great to see participation in a broad base of sectors and a broad base of markets. And most of the leadership is in economically sensitive sectors, which would belie the idea that we might have some kind of recession.
Mm-hmm.
So I think in general, we've got lots of liquidity in the market. Central banks around the world, sort of ex-US, have been loosening. And so I don't think this is a market where you want to fight the tape.
Are you still, are financials still your largest holding in terms of sectors?
Yeah, they are. They're almost 30% of our firm holdings. Now that includes banks, it includes some insurance companies, it includes the TSX, which falls into that sector.
Mm-hmm.
But the financials really benefit when short rates are low and long-term rates are sticky and high, and there's an opportunity to make money there. And capital markets have been strong, so the capital markets banks have been about the strongest. And so we have lots of exposure there.
You say in some recent commentary that investors need to protect themselves from the debasement of their purchasing power. What you refer to are easing monetary policy and populist fiscal policies. In other words, spend, spend, spend.
You know, there was this moment where you thought maybe, just maybe, some spending might get cut. And of course, the big, beautiful bill comes along and, you know, all of that goes out the window. So it's clear that governments are going to continue to have populist policies. And the bond market is telling you it doesn't love it.
Right.
But that ultimately is stimulus in the economy.
And ultimately, some of that stimulus makes its way to the stock market, correct?
That's right. And I mean, people have to be able to protect their purchasing power if there's going to be more dollars out there. And so companies that have had an ability to raise dividends or generate lots of cash, you know, have the ability to put their prices up tomorrow if inflation is up today, are the ones that are winning. And so we've sort of focused in those areas. That's
David Burrows. Those are his initial thoughts on the environment in the markets right now. We'll take a break, and when he comes back, he takes your questions on North American large cap stocks. Here again is the contact information, 1-855-326-6266 or marketcall@bnnbloomberg.ca. Welcome back. Let's start the questions coming to David Burrows. John is in London, and he's our first caller. John, thanks a lot for your call.
Thanks, Paul. What an all-star send-off you have. Reed, Bolton, and Burrows.
I do not disagree. I do not disagree.
And hello, David. I was going to ask about GE, but it was too complicated a question. I'll ask about Uber. I'm pleased about how it came off the bottom in April, and I'm pleased about its $300 million spend on Lucid to run its robo-taxis. What do you think of Uber for an ad and about a 18-month hold? Thanks.
Sure. So you'll hear today, one of the common characteristics we're watching for is companies that have strong and growing cash flow. And Uber, as you know, has gone from a negative cash flow company over the last 2 years to a very positive cash flow producing company. And, you know, this is a classic company, I think, for this environment. They have the ability to change their price tomorrow if their costs go up today. And so we want to own companies that, you know, don't have a ton of debt, that have an ability to have pricing power, that have a strong market position, and that are generating lots of cash. And so this fits right into that. Technically, the stock had a really nice sort of consolidation period between March of 24 and let's say April of this year.
Yeah.
And the stock's broken out and actually has had a nice little pullbacks from just below 100 to kind of 90. I think that's probably a really good entry point. And large cap growth still is an important engine in this market. And Uber obviously in that camp as well.
Okay. Thanks for the question. Let's go to Edmonton where Arden is on the line. Hi, Arden.
Hi, I'd like to ask your guest about MDA Space. It's now reached a new high today. Should this be time to sell, or is it worth holding on to? Thank you.
So we own MDA in our accounts. Never enough. But this company is really feeding into the growth in the satellite business and the sort of space-based Wi-Fi. And so we think that there is lots of opportunity for growth in competition to Starlink. And so stock's up a bunch. It's had a quick run from $30 to $41. I'm not sure I would want to bet on it, having a significant pullback. It's better than 93% of companies in the S&P over the last 52 weeks and trading above the 50-day, the 8-day, the 21-day moving average. So, it did have a nice basing period from November to May. And so there is some room to run here, I think.
Okay, interesting. Let's go to Victoria, BC. Chris is waiting on the line. Chris, thanks a lot for your call. What's your question to David Burrows?
Oh, good morning, Paul and David. And Paul, I've got to say very quickly that your professionalism, demeanor, and knowledge cannot be replaced.
Thank you. It's very nice of you to say that.
Oh, my pleasure. And David, if I could ask your opinion on Abbott Labs, please. It's pulling back today. It's been a very good compounder over the long term. The last 5 years, not so much. But I'm wondering if you see it as a good buy today for a 5-year hold. Thank you so much.
So, look, Chris, we always start with what's the universe we're operating in and how's it performing? So we like the market, but within the market, healthcare has been about the weakest relative strength sector. And it's a big sector, obviously, in the U.S. market. And that has included pharma, it's included biotech, it's included the healthcare providers, even the device companies. Abbott was an outlier, performing much better than the group. So I always like to say when breadth is deteriorating, meaning fewer and fewer stocks within the group performing well, sooner or later, they're likely to get to the leaders. And I would say Abbott would have been a leader in the group. So now they report their earnings today. They're narrowing the guidance. Forward-looking data, maybe not quite so strong. I think that there is not a lot of love felt for healthcare in general. And with other things going on in the market, it's not a hard decision for a portfolio manager to say, I don't need to have more healthcare right now.
Right.
I'll move on. So I think this is going to have to do some work for some time. Technically, it's kind of broken. We are not bottom feeders. We're trying to buy companies that are good getting better. And so I think I would not step into this one right now. I would wait to see healthcare start to perform a little better, see the technicals get a little better before you stepped in.
Okay, thanks for the question on Abbott Labs. Here comes a call from Colin in Sarnia. Colin, thanks for waiting on the line. What's your question to David Burrows?
Well, you're welcome, and good afternoon, gentlemen. Paul, I can't add any more compliments to those given, but I can give you advice. You can now have a beer at lunch without breaking any rules and enjoy it.
I'll take your advice
David,
on Monday afternoon. How about that? Go ahead.
Excellent. David, I am just baffled by copper, when to enter and who to enter with. Long term, it looks good, but there's just a whole lot of crazy going on in this market. So I'd like to hear your opinion.
Sure.
Thank you.
So look, when a sector is in transition, it doesn't happen all at once. very often at change points, you get a lot of yanking back and forth, and copper's a higher volatility sector, and so you can expect that. I think we've seen a significant breakout in the price of copper, and I think that over a period of years, we're going to see earnings double, we're going to see dividends in a lot of cases double, and we're going to see multiples double. And if you can get those things going at the same time, prices can be much higher. So the obvious way to play copper would be with a U.S. copper company like Freeport, where you're getting copper and gold. And so we do own Freeport. It's been a great sort of dividend growth stock over time, and I think that's not going to slow down. It's a big cash generator. We also own Hudbay. And so for us, the way that we want to play copper is in safe jurisdictions in general, multi-mine opportunities, but people don't necessarily look at natural resource companies as dividend growth stocks. I would look at them now because I think we're into a resource cycle that will go on for a long time.
Okay. There's a look at Hudbay, one of the stocks that David likes in the copper sector. We'll be back with David Burrows right after this. He's with Barometer Capital Management, and he's taking your questions on North American large cap stocks. Okay, let's keep the questions coming to David Burrows. Elliot is in Hamilton, and he's on the line. Elliot, thanks for your call.
Good afternoon, gentlemen. I believe it was yesterday or the day before, Bank of New York Mellon reported some excellent results. I mean, the 25% that comes from retail and commercial was good, but I love the 75% that's coming from the faster-growing fee-based parts of the business. What's your outlook, please, for BK? Thank you.
So yeah, they really reported some dynamite numbers, and in it some imputed return on common equity, which were off the charts good. Banks are very good with fees, and the Bank of New York Mellon's business is very fee driven, and so again, this is a situation where being able to put your prices up and having a strong market position with your customers is an important one. Of course, they're a huge custody bank, and they're good at it. So again, this is the type of company I like. It's had sort of mid-single-digit dividend growth, but I think there's a good chance that you could see that accelerate. So we don't own it. We could always own more, but we have a lot of financials as it stands right now.
Okay. Thanks for that question on Bank of New York Mellon. Jesse is in Edmonton. Jesse, thanks for your call.
Hello. I'm asking about the long-term prospects of uranium, specifically Cameco Corporation. Is there more upside in the stock? Thanks.
Yeah, look, I think that the uranium and the nuclear companies do have a long way that they can go. We are at the very early stages of a big growth cycle, it looks like, for small modular nuclear reactors and large-scale reactors. Cameco, of course, we always owned it for the uranium, but in purchasing the nuclear infrastructure business that they have, gives them lots of opportunity for growth. So if you look at Cameco's share price, it had a massive rally between 1999 and 2005, and that was a resource bull market. And then basically it didn't make a new high until 2023. So that's the beginning of a new bull market, and that's around the time most of the resources have made a nice turn. So I think we're early days. Now, Cameco is a leader in the group. It was the first one to break out to new highs. That often tells you it's the leader. And while it's had a big move kind of recently from 50 to 105, I think actually this is going to be a multi-bagger over the next 5 years.
Okay, he likes Cameco. Andre is in Chilliwack, BC. Andre, thanks for your call. It's good to hear from you again.
Well, good afternoon. I had to call and congratulate you on your retirement. I think you're much too young to retire, but that's your choice.
That is factually incorrect, but thanks for the compliment.
Okay. David Burrows, my favorite bull manager. Where are you on the bull cycle? 5 out of 10, 7 out of 10? I'd like to know where you see the market and very quickly, your thoughts, please, on Couche-Tard. This is the second deal now that's fallen apart. They tried to take over the grocery store chain, and now 7AI. I am a shareholder. Are you at all worried or concerned about management moving ahead? I'd like to hear your thoughts, David. Thanks. Have a good day to both of you. Bye-bye.
So I'll just start on the market cycle. The long market cycle, I think the secular bull market that started in 2013 in the U.S. Has some legs. Now that we have global markets engaged, it may well be that global markets outperform U.S. markets over the next decade, but there's room for multiple expansion there. The baby boom drove 1980 to 2000. The Generation X is going to push this market move probably into the early 2030s, with interruptions, the cyclical interruptions, but we think that there is room to move here. With that being said, on Couche-Tard, I'm certain that the Japanese are not easy to negotiate with, and it's not to say that they might not come back and re-enter this one. But look, Couche-Tard is great at integrating, and if they were able to get this deal done, we're not there right now. We likely would be back in the stock.
Right.
So never say never, but in the meantime, they're doing a great job operating the business. We're just a little cautious in general on the consumer as a group relative to the rest of the market. We own Dollarama and we own Loblaws, but that's really about it.
I'm wondering if Couche-Tard is going to get some criticism, Couche-Tard's management, for devoting so much energy to this and not coming away, not getting even close to a deal. You don't sound like you're of that mind.
Well, I'm just of the mind that this is a company now that's very large and they need to make big deals.
Right.
And so there's no catalyst in the near term for us to be there. So we'll wait and see. I don't think that it's a major problem, and I don't think it's a management deficiency. They're trying to do a big deal that they probably need to do. But that would be the next catalyst to see a deal get done.
Okay. Cynthia is in Toronto, and she's up next. Hi, Cynthia.
Hi, good afternoon. Thank you, Paul, for all your great programming throughout the years. I wish you all the best.
Thank you so much.
And David, I have a question for you. As the banks get to their peaks, I'm wondering, my mother's 97 and I'm investing for her. She bought them 30 years ago. They're now at their tops. So I'm wondering, what do you think? Should we be selling some, selling half, or I'm thinking the end of the year, it's not going to look so great for the banks. What's your opinion?
Well, I have to disagree with you because we have only just gone through a generational shift in interest rates, right? 2020, we saw a generational low in interest rates. The last one was 1951. And a long-term higher rate cycle is great for financials. It's why the XLF, which is the financials ETF in the US, didn't make a new high from 2008 until, 2022. And that started a new bull market. So our Canadian banks dodged the 2008 bullet. But, they're in good shape and they're performing well, and I would be in no hurry to sell them. We own a lot of U.S. banks, but J.P. Morgan's the best bank in the world. And they raised their dividend twice in the last year, and they win everywhere. I would encourage people to look at a global bank right now, and I really like Santander because they're all over the world. It trades at 9 times earnings versus, say, Morgan Stanley at 16 times. They've got a great digital platform, and if we think that global stocks can outperform, we want to own a global bank. And so I would take a look at SAN on New York.
Okay, great answer on the bank question. We will take a break, and when we come back, time to look at David Burrows' past picks. Okay, time for David Burrows' past picks. We will go back to a visit with David Burrows on Market Call on May the 17th of 2024. So about 14 months ago or so. Freeport-McMoRan was one of the picks on that day. He's mentioned it today, down on a total return basis 17% over that period. David?
Yeah, the copper stocks are very volatile. You know, we use stop losses on our position, so we did wind up coming out of it. Having said that, we re-entered it again about 2 months ago. And I think that on a longer-term basis, they should generate a lot of cash. They are a significant dividend grower, and they will be a beneficiary of sort of some of the headwinds for some companies, and with the tariffs, they should benefit from that.
Okay. Goldman Sachs, a company that reported its best ever trading quarter this week as the Wall Street banks rolled out their results. That was on Tuesday morning. Goldman Sachs, you can see the total return here, an eye-popping 54%.
Yeah, this capital markets group of banks, whether you're looking at Morgan Stanley or whether you're looking at Goldman Sachs or whether you're looking at RBC, you know, which has big capital markets exposure, are performing really, really well. And it tells you something about the rest of the market. If investors are focusing on these banks, then they obviously have a view that actually there's a lot of deals to be done and there's lots of opportunity in capital markets. So we think it's a tell. Just like we watch semiconductors, they're a tell in the economy. And I would continue to buy that stock. Morgan Stanley's great too. It's more investment management than trading. But that whole group is, I think, very attractive.
Okay. Finally, Thomson Reuters, TRI on the TSX, 25% the total return over the 14-month stretch.
So, you know, we spent a lot of time talking about AI over the last couple of years. And this is a company that is basically nothing but data.
Yeah.
And the opportunity to layer AI services over top of the data sets that they have for healthcare, for law, for financial services, you know, is significant. And I think that's the long-term story here and the opportunity. And I think it's very, very early days.
Okay. Thomson Reuters trading at a multi-year high and had a big move up this week. We will be back with David Burrows of Barometer Capital Management after this short break. He'll resume taking your questions on North American large cap stocks. Okay, let's keep the questions coming to David Burrows. He's our guest on Market Call. Brian is in Ottawa. Brian, thanks for your call.
Yes, my question today is on Tourmaline oil. About 2 weeks ago, give or take, the stock was trading well over 67. Since then, it seems to have been dropping on almost a daily basis and is now struggling in the mid-61s. I know ARC Resources has pulled back as well, but not as much as Tourmaline. And at the same time, the TSX has been, hitting new all-time highs every day. And I believe the price of natural gas has also been increasing. So my question, I guess, basically is, do you have any insights into this, any reasons for this recent weakness in Tourmaline? Do you have any concerns about the company, or do you see it as a buying opportunity? Thanks.
Brian, whether we're looking at Canadian natural gas stocks or U.S. natural gas stocks, lots of optimism about the future of liquefied natural gas. But remember, we're in the middle of July, and that's not generally a friendly time of year for these companies. I don't think that there is a fundamental issue here. ARC pulled back, as you mentioned as well, expand in the U.S. as well. I don't see gas prices as being broken, but seasonally, it's a tough time of year. So I'd give it just a little bit of space here. And your risk is, you give up some return in something else you might own. But as you get closer to fall, if you've got time, you're probably in good shape.
Okay. Let's go to Mose in Vancouver. He's up next. Hi, Mose.
Good morning, gentlemen. Paul, you have had an amazing career. All the best to you in your golden years.
Thank you so much.
David, my question to you is about AMD. It has hit new highs. Is it a hold or a sell? And if it is a sell, what would you recommend to switch into? Thank you very much.
Great. So the semis I mentioned earlier, we like to watch as an indicator for economic expectations. It's been a group that has led the rally over the last number of years. It has regularly checked back to the 200-week moving average. It did it in March of 2020. It did it in September, October of 2022. And of course, it did it and dipped below it in March and April of this year. So look, since April, the semis have rallied nicely. There's a couple of things I'd mention. NVIDIA is obviously the leader, and it is on making new all-time highs. The semiconductor index in the U.S. has not yet made a new high. That's a little something to think about because the market is. Its relative strength, it's come off a deep low. So I don't think that there's anything in the near-term charts I can point to as an issue. AMD is performing very well. In the back of my head, I would love to see the semiconductor index make a new high. And so I do watch that. But AMD, is an alternate, that there is going to be companies that pick up market share and opportunities, behind NVIDIA. We prefer to be with the leader, NVIDIA itself. And so we'll see. But I think that the semis are giving you good messaging right now. The caveat is I'd love to see the index make a new high.
Okay. Thanks for that question from Mose in Vancouver. Let's go to Pat in Mississauga. Hi, Pat.
Hi, guys. Thank you for taking my call. Paul, congratulations on your well-deserved retirement.
Thank you.
And David, I'm a current holder of Broadcom. I've held it for some time, and I've made a handsome return on it. I'm just wondering, are we reaching a high here? Should I take some money off the table, or should I continue riding this to a higher high? Thank you.
Great. So, look, the way we look at this is, and I come back to this, the last caller, we want to own the leading stocks in sectors that are in favor. So, breadth in the semiconductor sector is improving. NVIDIA made a new high. Broadcom's made a new high. It's trading better than 94% of companies in the S&P over the last 52 weeks. They made a new 5-year high. So the way I would handle this is I would follow it with a trailing stop. If we own 20 positions in a portfolio, 3 or 4 work out way better than we thought. 7 or 8 are pretty good and a bunch don't work. So I think our success as investors is to hold the positions that are working as long as they continue to do what they should be doing, given what you think and get the heck out of Dodge on the ones that don't work. And by using a stop, it lets you stay in these positions until you see something's changing. And so right now, I would be there. And we own Broadcom and we own NVIDIA.
Okay. Thanks for that question. Let's go to Toronto, where Perry is on the line. Hi, Perry.
Yes, hi, dear. Good afternoon. Thank you for taking my call. I just wanted to know about Pfizer. Thank you very much.
Thank you.
Hi, Perry. I just would say the same thing about Pfizer I said about Abbott, although Pfizer has been a laggard in the healthcare sector. I don't see anything at this point that points to a turnaround in healthcare in the near term. Sort of has a target on its back as far as, their margins may go. So, the stock has bounced over the last, few weeks. I would probably use the strength to move on.
Okay. Let's go to Jim in Pickering, Ontario. Jim, thank you for your call. What's your question to David Burrows?
Well, thank you for taking my call, and best of luck to everybody there at BNN Bloomberg. David, my idea today, or my question, is about Dollarama. In some ways, it seems too simple, and yet with the disappearance of so much bricks and mortar retail, I'd just like to get your opinion on that. Thank you.
Sure. So, Jim, when I look at the dollar stores, even last year when the U.S. dollar stores were really having a tough time, Dollarama was chugging ahead. One of the reasons that investment banks like retail is that if a concept works in one location, it can work in a lot of locations. And so very often when a retailer starts to have success, the stock can really enjoy a run because you can just keep rolling out more stores, and Dollarama has done exactly that. The Rossi family have done a great job in growing that business. They've been great buyers. They've been great operators. And so it's not a cheap stock. We own it, and we've owned it for 2 or 3 years now, and it's been just a wonderful gift that's kept on giving. I don't want to bet against it. And it's sort of the same as we own Fairfax. And you look at Fairfax versus Berkshire, and it continues to outperform Berkshire. So look, be happy that they're good operators and back that business until something changes.
That is our final question to David Burrows. Actually, we're going to have more questions. That's not the final question. We're going to take a break, and we'll be back at least one more time for questions with David Burrows on your questions on North American large cap stocks. Okay, let's keep the questions coming to David Burrows. He's our guest on Market Call. Jen has written us an email. Jen writes as follows: what do you think about buying Celestica?
I wish I'd bought it.
Yeah.
I in general haven't liked the contract manufacturers because the margins are very, very thin in general. But when they get on a roll, they get on a roll. And Celestica's in a great space. We all know they're going to continue to build data centers. And Celestica is a big winner in that area, of course, through all kinds of other things too, aerospace and healthcare and so on. But the stock has definitely been a significant winner. Their earnings momentum is very strong. They are seeing consistent upgrades to their earnings estimates, which you would want to see in a growth stock. It's better than 98% of companies in the S&P over the last 52 weeks. So, it's a little stretched above moving averages, and it would be susceptible to a miss. But they report earnings in 11 days, and there's no sign that this one is got big risks. So I don't own it, and we probably should have owned it.
That will be a keenly awaited set of results from Celestica. Let's go to Steve in Vaughan, Ontario. Steve, thanks a lot for your call.
Hi. I wanted to wish Mr. Bagnall the very, very best in his retirement. I hope that all your goals and ambitions come to fruition in spades.
Thank you so much. That's very nice.
The best to you, sir.
Thank you very much.
And thank you for everything you've provided people like me. You've been very informative and very helpful. Mr. Burrows, I was just wondering, I own Microsoft in a RIF. I've done very well with it. I was just wondering, do you think it's time to take some off the top a little bit and maybe because it's a RIF, I have to take out a certain amount? Should I just choose something else and let it ride, or what would you advise?
Right. So going back to the beginning of the show, we talked about companies that are big cash flow generators. Microsoft is a giant cash flow generator. It's a machine. It's been a great dividend grower over time. Dividend is not big, but it's a dividend growth stock. If you look at the boxes to check of the Magnificent Seven, there's a bunch that have not made new highs since they sold off through the winter. Microsoft has. They are a winner in the cloud right now, and they have lots of opportunity with Copilot. They've got great business platforms that they can charge for. We own the stock. We do have like a significant underweight in tech right now. We're only about 7% technology. So that's but Microsoft is one of the positions that we have. So I have a hard time punching holes in it right now, other than it's expensive, but they've proven that they can execute. So large cap growth is one of the strongest areas of the market. I think it's a stock that you can own. Okay, thanks, Steve. Let's go to Diane in Ottawa. Diane, thank you very much for your call. What's your question to David Burrows?
My question is about Franco-Nevada. I would like to know his thoughts and also what would be a good entry point in that stock. Thank you, and have a wonderful retirement.
Thank you so much, Diane.
So Diane, the precious metal sector is one that we really like, and it's had a wonderful move this year and over the last couple of years, but I think we're in the very early stages. When we went back and looked at the previous two bull markets, one in the 70s and 80s and one through the early 2000s, after the first significant move, there was about a 12 or 14 week period of consolidation. And in April, I think I was on here, I said, look, there's a chance that we see some consolidation in the sector through July or the beginning of August, and I think that's what's playing out. Franco, as a streamer, isn't the most leverage to gold prices, but it's the safest and probably most consistent company, that maybe wheat and precious metals. So I think this pullback's probably an opportunity. It's trading above all the moving averages. Moving averages are moving higher. It's been a good dividend grower over time, and it will continue to be. I think over the next couple of weeks, there's an opportunity to be adding to the precious metals. We'll talk about one today. It's a great company.
Okay. Let's go to Evie in Edmonton. Evie, thank you very much for your call. What's your question to David Burrows?
Good morning, gentlemen. My question is regarding Qualcomm. Although I've seen it as a top pick in this program, it seems to be lagging other tech companies. Mr. Burrows, what is your outlook for this company? Thank you very much.
Yeah, so you said it. It's a laggard in the group, and there's no sign that that's changing. In fact, I think it's making a relative strength new low today versus the market. When you're in a bull market, you want to own stocks that are participating because you don't get bull markets very often. And so Qualcomm has been unable to make a higher high since it made its high back in June of last year. So I would steer clear, and it has rallied a little over the last few weeks. If I owned it, I would probably take the opportunity to step aside and move somewhere else.
Okay. Here comes a question from Kimberly by way of the email inbox. Could I please get your thoughts on Enbridge?
So something to think about. If the leading sectors in the market are sectors that would benefit in a more inflationary environment, and they are, financials, industrials, materials, some energy, you want to look at the groups that are not. And so things that act like bonds, utilities, staples, real estate investment trusts, pipelines, they are underperforming. Now, it may be that people piled into some defensive stocks, in April thinking that, they should own those, but they just haven't performed. So when you've got these other groups that are economically sensitive performing, these defensive groups are being seen as a source of cash, right, to go somewhere else. Enbridge pays a great dividend, and they'll grow their dividend mid-single digits. I think that's true. I just think I would prefer to be leaning more towards hedging against inflation than disinflation, which is what you would do with a pipeline or a bond proxy.
Okay. Thank you very much, Kimberly, for your question. And that is the final question to David Burrows today. But don't go away just yet. David Burrows' top picks are right around the corner. Please join us tomorrow on Market Call. Lyle Stein will be on the show. He's president of Forvest Global Wealth Management. He'll take your questions on North American stocks and global stocks. And if you ever miss an episode of Market Call, check out our daily podcast. You can find it on iHeartRadio and other prominent podcasting platforms. And you can watch full episodes of our show on our YouTube channel as well. Okay, it's time now for top picks from our guest, David Burrows. And number one today, not in terms of preference, but in terms of sequence, GE Aerospace, ticker symbol GE in New York.
Yeah. So if you take our premise that we want to own things that are good, getting better. So they're growing, but where you can get multiple expansion as people come to understand what's changing for the better. GE Aerospace is a great example. Of course, the old GE get broken up. When they do that, they often set the separate parts up for success. So there's GE Vernova, which is in power generation, which we also own, and GE Aerospace. GE Aerospace powers 3 out of 4 commercial flights with their engines. Their 2 big businesses are the engines themselves, and there's the service. So the fleet of aircraft globally is as old as it's ever been, partly because they're waiting for the next generation of GE engines. 70% of GE's revenue is service revenue that has a long contracted fuse on it. So the company reported their earnings today. The bar was pretty high, and they beat nicely above the bar. They also gave long-term guidance, saying that they grow revenue at least double digits over the next 3 years, and they're going to return a lot of capital to shareholders. So they're generating a lot of cash that they don't necessarily need. They can buy back shares. They can increase the dividend. They think that they'll increase the capital returns by 20% over the next couple of years. But then long term, you get the next generation of engines. So they're both for commercial aircraft and defense. We know the defense stocks are on a tear. And we know there's a long-term secular bull market in travel globally as travel just becomes a bigger and bigger business. So we think that the multiple can expand, the earnings can expand, the dividend can grow, and it's unlikely to be hurt by some major slowdown that doesn't appear to be coming.
Okay. Number 2, and David referenced that he would have a precious metals pick in today's segment. Agnico Eagle Mines is that pick, AEM in Toronto.
Look, we can talk about lots of smaller and mid-cap stocks that have lots of opportunity, but for a broad number of people in their portfolio, Agnico's a great way to get exposure to precious metals, which I think probably has a multi-year bull market in front of it. As it is, the company generates a ton of cash. In 2024, they generated about $2.2 billion. This year, they'll have about a 30% growth in cash flow generation. And this is assuming lower gold prices than where they are now. And they have been paying down debt. They want to put about $1 billion of cash on their balance sheet. Once they do that, they're going to look at increasing dividends. They have had a share buyback consistently over the last 3 years. They've got a $5 billion buyback out there right now. So this is a company that is in safe jurisdictions. They've proven they're the best operators in the business. They've got relatively long reserve life, and they've got lots of opportunity to increase their reserves at existing mines. So it's a good way to have some exposure in your portfolio.
Okay. What is your outlook on the price of gold? And is that pertinent to selecting a gold miner? I think that it is. I mean, you can get more leverage by buying a high-cost producer. Right. I'm not trying to do that. I'm trying to focus on the highest quality. And as they used to say, a gold mine is often a hole in the ground with a liar standing on top. These guys have been pretty good. Right. So I think that you want to stick with the strongest folks, and Agnico really are that. Okay. Final top pick today: Imperial Oil, one of the stalwarts of Canada's oil and gas industry, IMO in Toronto. Yeah. So look, the oil and gas sector has been consolidating, and Imperial Oil is breaking out to new highs. That's a great tell. Mm-hmm. Right? 25 years of reserve life. They've had 3 separate issuer bids between 2022 and 24. You got another one right now. They've had 30 years of consecutive dividend increases, 2.6% dividend. Compound annual growth rate of the dividend has been 22% over the last 5 years. If you want a company that's going to protect your purchasing power, this is a great one. So it's as simple as that. It's just a very high quality company. We think that if the commodity cycle is going to go on, likely energy is going to participate. This is the time of year they should be weak, and Imperial's making new highs. Mm-hmm. I think that tells you that there's lots of upside. And when you say oil's going to participate, you're calling for longer-term higher oil prices. Longer-term higher oil prices. If you look at the ETFs, I use point-and-figure price charts. If you look at the ETFs for the producers and the service companies, they pulled back a little. They've got very strong point-and-figure charts. And the point-and-figure chart for oil
is, higher highs and higher lows more recently. So I think that this is probably a good time to think about entering and starting to build a position.
Okay. David Burrows' top picks on this day: GE Aerospace in New York, Agnico Eagle Mines in Toronto, and Imperial Oil in Toronto as well. David, I want to say that this will be the last time that we speak in this way, but just like our viewers, I have learned a ton, an absolute ton, just by sitting here and listening to you talk about stocks. So I want to thank you so much for the effort that you put into these segments. You always prepare and are ready to talk about stocks with our viewers, and I just want to thank you for doing that.
Well, Paul, it's been a pleasure being on with you. So congratulations on your retirement.
Thank you so much. David Burrows, our guest on Market Call. He'll be back. We will take a look at markets right now. We'll take a look at some of the market indices, how North American markets are trading. It is a positive day across North America. The S&P TSX Composite Index, that looks like a new intraday high on the S&P TSX Composite Index. I'll get you the number. We have 30 seconds left in our program. The TSX trading at 27,300 points. The high today has been 27,328 on the S&P TSX Composite. Thanks for watching Market Call. Trading Day with Andrew Bell is up right after this.